The history of mortgages. I think that's a really, really, really interesting place to start, just to kind of give you how we came to be here. And I'll make it not 3 hours, it'll be more like 5 minutes. So in the beginning, first of all, there wasn't a mortgage, there was the feudal system, right? Landowners and non-landowners. And as we came into city-states and everything, we started having people that would buy tenements for cash and buy properties for cash, and then of course we homesteaded here in America, so you could go out and you get your 500 acres and claim your piece of the land, and then all of a sudden the common man, as it were, got into the idea of homeownership. So lenders, direct lenders, kind of came onto the scene, probably late 1800s, early 1900s. And these direct lenders said, hey, I'll give you money, and I'll give you money to borrow to get your house, right? And you have to pay me some fees and some interest over time, right? That's kind of the basics of it. But it was always a 20% down, at least, product back then. There was no possible way of putting down less than 20%. So that worked and kind of moved forward with it. There were farm loans, there was all these things. Well, and then the Great Depression happened. And so in the Great Depression, Ginnie Mae and Farmer Mac were created. And Ginnie Mae is FHA, and Farmer Mac is Farm Home Loans. And FHA was the first one to say, listen, the government will back and guarantee your losses, okay? You can put down as little as 3.5%, and if something goes wrong, the government will cover the bank's loss. So now we have all these different products. We have FHA, and then the 50s VA came along, I believe after World War II, the VA home lending came along. And then we also, out of Farmer Mac, spun Freddie Mac, and then its counterpart, Fannie Mae. And so a Fannie Mae and a Freddie Mac loan are what we call a conventional loan. A VA is a VA loan. A Ginnie Mae or an FHA loan is an FHA loan. All these loan products that we know today actually have, a pretty long history. And they've changed, they've morphed over the years, but that's where they've come from. But the biggest, kind of most revolutionary thing is when the government came out and said, you can put down less than 20%, and if the borrower doesn't pay, we'll help you cover their loss. So FHA doesn't do mortgages, lenders do FHA mortgages, right? And so when we do an FHA mortgage, the borrower puts down 3.5%, FHA says write it to our standards, and if that borrower stops paying money, we will help cover that 16.5% loss that you took as though they had put down 20%.
So it only covers up to the 20%?
It generally does. There's different coverages amounts, but it never covers the whole thing. VA covers 25%. Now, out of that was spun private mortgage insurance. So the whole reason, I like talking about this because people think of mortgage insurance as a bad thing because it's an extra fee that they're paying to insure themselves in case they don't pay. But literally without it, there's no non-20% down loan option, right? So it opened those doors to make that possible. Most of our home buyers are not putting 20% down, particularly our first-time home buyers, okay? There's all sorts of deviations of these loan programs and derivations, I guess I should have said. So we can kind of get into that. What's important to know is that in America, about 97% of all loans funded are government-backed. It used to be, up until the crash in 2008, that Fannie Mae and Freddie Mac, who did all the conventional loans, were what was called government-sponsored enterprises. That's a fancy way of saying privatize the profits and publicize the losses, right? There's a better way to say that. I can't think of the phrase. Okay? Socialize the losses, I think is what they say. That's what happened. Fannie Mae and Freddie Mac, still, by the way, to this day, the most profitable per employee corporation in the world. They make over $1.5 million per employee, Fannie Mae and Freddie Mac, okay? When they started really losing and they were going to go under in 2008, the government said, we absolutely cannot have this happen. The government stepped in and took them over. Now that they're so profitable, the government's like, yeah, no, we're keeping them. They're good, right? And that's what's happened. That's how those became government loans. But see, all these lenders came from the concept that came around in the 80s known as securitizing. So up to this point, again, it was mostly lenders lending their own money with maybe the backing of FHA or VA. What securitizing is it's now what about 99% of all lenders do. That's it's high. It's got to be 98, 99%. So I'm trying to think of one local bank. The only local bank that doesn't securitize their mortgages is Washington Federal, to my knowledge. Everyone else securitizes. So what that means is that they close this $300,000 loan, right? And then they take that loan and they put it in a pool with $1 billion of loans. And then they sell that $1 billion to Fannie Mae or Freddie Mac or FHA. And then Fannie Mae or Freddie Mac guarantees a return on those funds, splits them up into bonds called Ginnie Mae or Fannie Mae bonds, and sells them in the international market, those bonds. And that's where the money is created to create these loans, right?
Is that an ETF?
It is not.
It's a mortgage-backed security.
It's a mortgage-backed security.
Okay.
Yeah. And so the value of those mortgage-backed securities on the open market, sorry, I gotta take this jacket off, is what creates the interest rates. So the way it works is that we would say today, we could close your loan for 4.5%, and it's a $100,000 loan, and then we can turn around and sell it for $103,000. And that's where the bankers make their money. That's why, a lot of times there's no points, no fees, all this, because the money is made after delivery of the loan in the back market. So it's called service release premium. It's the premium we get for securitizing that loan. Okay. Now, some lenders service their loans and some lenders don't. Caliber is a servicing lender. We service about 90% of our loans. But servicing, again, isn't ownership, and that's where people get really, really confused. You can sell the loan to Fannie Mae and still have master servicing rights. Okay, and as a master servicer, you're entitled to a portion of that interest, but most of that interest goes into paying back those bonds. All right? There are non-master servicers, like locally, like Umpqua and Wiku and Peoples. They all have a master servicer, which is like U.S. Bank, but they get to put their names on their statements, so they can portray that they're saving the servicing rights. And so, I know that's kind of like Mortgage 102, but it's just kind of interesting to see how it all works, because it really is a pass-through business, right? I think a lot of people think that we make our money by the long-term interest, right? And it's not like that. It's the delivery fee that we make for closing that loan. And then those bonds are sold, into the open market, and they're making that long-term interest. It's the reason the rates are so low is because it's considered a super safe bet to buy these Fannie Mae and Ginnie Mae bonds, because it's backed by the full faith of the American government, right? Much like 10-year Treasury notes and things like that. All right. So there's 3 different channels of delivery into the market, into the securitization market. There's what's called a mortgage broker, there's a correspondent lender, and there's a retail lender. All right? A mortgage broker is someone who does not fund the loan in their name. They deliver the loan to a third-party bank, right? So like Neighborhood Mortgage, where I used to work for 10 years as a mortgage broker, classic mortgage broker. So we're not closing loans in our own name. Did you have a question?
No.
We're just simply, lining up you, the client, with Flagstar Bank or with Caliber Bank, or what we call a wholesale lender. Caliber also has a wholesale channel. There's a correspondent lender. A correspondent lender is one who they close the loan in their own name, but they sell it right after closing. So they'll get like a line of credit for like $10 million with a correspondent lender, and then they'll use those funds to close the loan, and then turn around and sell the loan back to that lender, and then get those funds released. So it's just a revolving line of credit. Quicken's is actually massive. Quicken's a retail lender. So Quicken's one of the largest lenders in the country. I'll give you a correspondent lender would be Bank of the Pacific. Bank of the Pacific delivers about 90% of the loans actually to Caliber on the back end. Another correspondent lender would be, let's see, I'm trying to think. Umpqua is correspondent. They do retain their servicing rights though, but they sell, I think U.S. Bank is the master servicer. So except for the few, like the 10 really, really big lenders, most other people are correspondent lenders. The non-correspondents would be like Wells Fargo. Like that's like the biggest lender around, right?
But they're selling to other banks, not to Fannie Mae or Freddie Mac. Is that the difference with the correspondent?
Yes. They're selling to other banks who are then delivering it to Fannie Mae or Freddie Mac.
Okay.
That's exactly right. That's exactly the difference. So, yeah, that's kind of who I'm thinking of as far as who's a correspondent lender. There are also like hybrids, like as Caliber is a retail shop, so we're closing our own loans and sending them to Fannie, but we don't kind of check off all the, like there's some loans that we can't do. So we also can have a correspondent relationship on the back end. Like we have a correspondent relationship with Chase, as an example. That's who we deliver a lot of our jumbos to because they have great jumbo loan pricing, right? We have a broker relationship with Washington Federal because they can do the Canadians, right? So there's a lot of, like a lot of lenders will kind of have mix and match type of things. And you know, in that process, there's really pros and cons to each, right? There's pros and cons to being a broker. It's great to be a broker. You're independent. You're not so corporate. Like that's where I was a lot of times. It's great to be retail. You have direct line to all your underwriters. You'd work with the same teams all the time. You're both working for the same company as opposed to with a broker where you're actually working for different companies, right? But then also you're kind of have to adhere to that corporate structure. So like, there's just pros and cons on each side of it. So then the actual loan process and the loan programs and overlays would be the other thing that I think we should go over. So just to take a quick break, I know we kind of talked like broad level. Do you guys have any questions or thoughts about any of that?
You're with Kevin.
So
It's relevant.
it is. I got into the business in 2004. And we mostly just only sold subprime loans. So subprime loans were privately held loans that had subpar, like we could do 100% financing down to a 560 credit score. We could do 80% financing down to a 480 credit score. Things were different. We could state loans, right? I worked at McDonald's and made $20,000 a month. Like it just didn't matter. The truth, you know, the subprime thing really got out of hand. What had happened was a few people came out and said, we're going to start doing these subprime loans and we're going to charge, 8, 9, 10%. And we expect the default rate on them to be about, I don't remember the number, I think they were predicting around 25 to 30%. So they were pricing them appropriately based on that default rate. But then they started securitizing these subprime loans into larger pools and selling them to like hedge funds and pension funds and things like this. And what they did was when they started doing that, they portrayed it as only an 8 to 10% default risk. So they said, look, you're getting a 7% return, you only have an 8 to 10% default risk. Moody's, Standards & Poor's, they started rating these as AAA, bonds when they really weren't. So there was a subset of the people that had created them that knew the default rate was going to be higher. But because the market was getting AAA rating and they were being securitized at this lower hypothetical default rate, it means that the rates on the subprime loans started going down. They went down from 10 to 9 to 8, 7 to 6, indicative with the risk that the market thought there was, right? You can handle a 30% default rate if you're making X percent enough on all the other loans that don't default to make it work, right? Well, a lot of misinformation led to, we ended up with about an 18% default rate when it all went wrong. So the guys at the beginning that were predicting 25 to 30, they were like, well, yeah, we actually, this is better than we expected. But the market was only built for an 8 to 10% default rate. And because of that, the whole thing just completely collapsed.
Just like that, good timing.
Just collapsed.
My battery went